Everyone's talking about Palantir these days. You've probably heard it called the AI Messiah or the next trillion-dollar company. Retail investors are absolutely obsessed with it, scrolling through forums at midnight, watching videos back to back, reading every piece of news like it's scripture. The stock ticker, PLTR, is trending on social media platforms like it's the hottest tech breakthrough since the iPhone first changed the world. Turn on any financial news channel, scroll through investing subreddits, check YouTube recommendations, and you'll find Palantir everywhere. It's become more than just a stock. It's become a movement, almost a religion for some investors who believe this company will reshape civilization itself. But here's the question nobody's asking, the question that should be keeping you up at night. What would someone like me think about this stock? I've spent more than 6 decades analyzing businesses, studying balance sheets, meeting with management teams, and watching market cycles come and go. I've seen the best companies in the world and the worst frauds imaginable. I've witnessed bubbles inflate to absurd proportions and watched them pop with devastating consequences. So when I look at Palantir with fresh eyes, cutting through all the noise and hype, what do I see? Is this the next Apple? The kind of once-in-a-generation investment that changes your life and sets up your children's futures? Or is it more like Pets.com, one of those companies that sounds brilliant on paper, has a compelling story, attracts passionate believers, but ends up bankrupting the people who believe the hype and bought at the top? Let me walk you through the truth beneath all the noise, the marketing, and the excitement. I've spent decades analyzing businesses using a systematic approach, and I've developed 17 clear, specific reasons why Palantir might be a trap that's about to snap shut on unsuspecting investors who don't understand what they're actually buying. Let me start with something fundamental, something I consider to be the bedrock of intelligent investing. I've always believed in staying within what I call my circle of competence. This isn't about being smart or dumb. It's about being honest with yourself about what you truly understand versus what you only think you understand. I buy what I understand deeply, businesses where I can predict with reasonable confidence how they'll perform 5, 10, 20 years from now. When I invested in Coca-Cola back in 1988, I knew exactly what I was buying down to the molecular level. The company sells sugar water. That's it. Simple, delicious, profitable, addictive in the best possible way. The business model fits on a napkin with room to spare. A child could understand it. You take water, add syrup, carbonate it, put it in a bottle, or can distribute it globally, and people keep buying it year after year, decade after decade. The formula hasn't changed meaningfully in over a century. You could explain it to a 5-year-old and they'd not only get it, they'd probably want to start their own lemonade stand based on the same principles. But Palantir, this is where things get murky, where the clarity disappears and you're left grasping at buzzwords and vague concepts. They throw around terms like ontology, which sounds like something from a philosophy textbook. They talk about Gotham and Foundry, which sound like they belong in a Batman movie or a medieval fantasy novel rather than in a business presentation. These aren't just clever product names designed to sound cool. They represent complex software platforms that integrate data from dozens or hundreds of different sources, apply machine learning algorithms, create visualizations, and supposedly help organizations make better decisions. But what does that actually mean? How do you know it works? How do you measure the value it creates? Can you quantify the return on investment? Now ask yourself honestly, right now, in this moment, do you really know what Palantir does? Not what the marketing materials say, not what some enthusiastic YouTuber told you, but what they actually do mechanically, operationally, day to day, Can you explain their business model to your spouse at dinner without using industry jargon or buzzwords? Can you describe how they make money, retain customers, fend off competition, and scale their operations? If you're being truthful with yourself, the answer is probably no. And that's okay. Most people can't. You know the hype. You know the ticker symbol. You might even know they work with the CIA, the FBI, with major corporations, with intelligence agencies around the world. But the actual mechanics of how they create value, how they sustain competitive advantages, how their economics work at a granular level, that's fuzzy at best, completely opaque at worst. You're buying based on trust in the story rather than understanding of the business. And here's my ironclad rule, the principle that has saved me from countless disasters over the decades. If you can't explain a business to a 5-year-old in simple language, you shouldn't be putting your hard-earned money into it. Complexity is not a virtue in investing. It's not a sign of sophistication or forward thinking. More often than not, it's a red flag waving frantically, trying to warn you away. The best businesses are simple. Railroads move things from one place to another. Insurance companies collect premiums and pay out claims. Banks take deposits and make loans. Simple doesn't mean easy, but it means understandable. Palantir fails the simplicity test spectacularly, and that alone, before we even get into valuation or financials, should make you pause and ask some hard questions about whether this is really where your money belongs. But let's say you're willing to overlook the complexity. Maybe you think the future is complicated and you need to embrace it. That old-fashioned simplicity is quaint but outdated in the age of AI and big data. Fine. I can respect that perspective even if I disagree with it. Let's move past the complexity issue and talk about valuation, because this is where things go from concerning to downright alarming, from yellow flags to bright red sirens. Palantir's price-to-sales ratio has been floating around 50 to 100 times, depending on when you check. Some days it's 60, some days it's 80, some days it spikes over 100. Let me put that in perspective for you with some concrete comparisons so you understand just how insane these numbers are. The S&P 500, which represents 500 of America's largest, most successful, most profitable companies, trades at about 2.5 times sales. Companies like Microsoft, Apple, Johnson & Johnson, Walmart, Visa, all of them averaging around 2.5 times sales. These are businesses with proven track records, massive cash generation, global operations, and decades of consistent performance. Palantir is asking you to pay 40 to 50 times more per dollar of revenue than this collection of elite companies. You're essentially paying for 40 years of sales up front, hoping and praying that everything goes absolutely perfectly for 4 decades. Think about that time frame. 40 years ago was 1984. The personal computer was just becoming mainstream. The internet didn't exist for consumers. Smartphones wouldn't be invented for another 23 years. Can you imagine trying to predict in 1984 which companies would dominate in 2024? It would be nearly impossible. Yet that's exactly what Palantir's valuation is asking you to do. This isn't investing anymore. This is gambling. It's like walking into a casino and putting all your chips on 00 because you have a feeling, because the person next to you just won, because everyone's talking about how 00 is hot tonight. I've always said that price is what you pay, value is what you get. And right now, you're paying a Ferrari price for what might turn out to be a skateboard. The math simply doesn't support this valuation unless Palantir becomes the most dominant, most profitable, most essential company in the history of technology. And even if they achieve that nearly impossible feat, you're probably still overpaying by a massive margin. Think about it this way. If you pay 100 times sales for a company, it needs to generate profits equal to all those accumulated sales just for you to break even. The margin for error is zero. Actually, it's less than zero because you also have opportunity cost. Now let me talk about something that really bothers me. Something that keeps me up at night when I think about shareholders in this company. Stock-based compensation. I despise it. Always have, always will. Stock-based compensation, or SBC as it's politely called in earnings reports, is a hidden expense that companies love to sweep under the rug to categorize as non-cash, as if that makes it somehow not real. But make no mistake, it is absolutely real, and it's costing you a fortune. Palantir is one of the worst offenders in this category that I've ever seen, and I've been studying companies for over 60 years. They pay their employees primarily in stock, not cash. Engineer salaries, stock. Executive bonuses, stock. Retention packages, more stock. It never ends. On the surface, this might sound clever to someone who doesn't think deeply about it. Hey, it conserves cash, right? The company doesn't have to pay billions in salaries so that cash can be used for growth, for acquisitions, for whatever. And it aligns employee interests with shareholders because everyone owns stock, everyone wants the price to go up. That's the theory you'll hear from management and from analysts who should know better. But here's the brutal reality that nobody wants to talk about. Every single share they give to employees dilutes you, the outside shareholder. Your slice of the pizza gets smaller every single year, systematically, predictably, relentlessly. It's like owning a business in partnership with someone who keeps cutting himself bigger and bigger pieces while telling you everything is fine. We're all in this together. We're a team. The share count at Palantir has been exploding. We're not talking about small numbers here. We're talking about 3%, 4%, 5% dilution per year. That compounds viciously. Let me do the math for you in stark terms. If Palantir dilutes shareholders by 4% per year, which is a conservative estimate based on their history, then over 10 years, you lose about 33% of your ownership. Think about that. You buy 1,000 shares today, and 10 years from now, those 1,000 shares represent only 670 shares worth of the company. Where did the other 330 go? They went to employees. You paid for those shares with your money, and they're being given away to insiders. And here's the kicker. You still own 1,000 shares on paper, so you don't even feel the theft happening. It's invisible until you actually calculate the percentages. I've asked this question for years in shareholder meetings, in interviews, in my letters. If stock options aren't compensation, then what are they? Decorations? Party favors? Of course they're compensation. They are the single largest expense at most tech companies, dwarfing rent, dwarfing marketing, sometimes even dwarfing traditional salaries. And when you give away millions upon millions of shares to employees, you're systematically transferring wealth from shareholders to the workforce. Palantir has been absolutely relentless with this practice, showing no signs of slowing down, no shame, no apology. The share count keeps growing like bamboo, which means even if the company's total value stays exactly the same, your percentage ownership is shrinking every quarter like ice melting in the sun. It's a wealth transfer, plain and simple, and you're on the losing end of it. The employees are smart, they're getting paid. Management is smart, they're dumping their stock. But you're holding the bag while your stake evaporates. Wall Street analysts love to talk about EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. It's a metric that sounds sophisticated and technical, but is really just a way to make companies look more profitable than they actually are. It strips out all the inconvenient expenses that make the numbers look bad. I don't pay attention to EBITDA. Never have, never will. Charlie Munger once called it nonsense earnings, and he was absolutely right. I focus on what I call owner earnings, a concept I've written about extensively in my annual letters. Owner earnings is the real cash that ends up in your pocket after all the actual expenses are paid. All of them. No exceptions. No accounting games. It's what you could pull out of the business each year if you owned the whole thing. When you look at Palantir's financials through this lens and you start subtracting the stock-based compensation from their reported profits, which is a real expense no matter what the accountants and executives say, the picture changes dramatically. Suddenly, the story doesn't look so rosy. For years, Palantir wasn't actually making any money when you accounted for SBC properly. They were burning cash, not creating it. They were paying employees with stock dilution instead of cash, but calling themselves profitable because stock compensation doesn't count as a cash expense in GAAP accounting. It's like a homeowner saying they're living within their means while maxing out credit cards and taking out a second mortgage. Technically, you're not spending more cash today, but the debt is accumulating, the interest is compounding, and Judgment Day is coming. A business that doesn't generate real cash after all expenses is not an investment. It's a hobby. It's something you do for fun, for passion, for the excitement, but not something you rely on to build generational wealth. Palantir's profitability has been accounting magic for most of its existence. Numbers adjusted and massaged to look better than they are. When you strip away the illusions and look at the real cash flows, the actual money that could be distributed to shareholders if management wanted to, the story becomes much less exciting. And here's the problem. At some point, the market will figure this out. At some point, investors will start demanding real earnings, real cash, real returns. And when that day comes, companies that have been playing accounting games will get absolutely crushed. Let's examine another massive risk that keeps me up at night when I think about Palantir, something fundamental to their entire business model: customer concentration. Roughly 55% of their revenue comes from government contracts. That's not a typo. More than half of their entire business, more than half of every dollar they bring in, depends on one customer. And that customer is the United States government and its various agencies and departments. Now, governments are fickle creatures. They're not like businesses that operate based on profit and efficiency. Governments operate based on politics, ideology, budgets, public opinion, electoral cycles, scandals, investigations. Political winds change direction faster than weather patterns. Priorities shift with each new administration. Budgets get slashed when there's a push for austerity, or when there's a recession, or when public sentiment turns against certain types of spending. If there's a change in presidential administration, if Congress decides to tighten spending on intelligence or defense or technology contracts, if there's a major scandal involving Palantir's work or a privacy nightmare that blows up in the media, if there's a push to reduce reliance on private contractors and bring more capabilities in-house, Palantir's revenue could take a massive, sudden, devastating hit overnight. This isn't theoretical speculation. This is how government contracting works. I've been around long enough to watch companies rise and fall based entirely on their relationship with one or two big government customers. And the falls are never pretty. They're sudden, they're brutal, and they're permanent. I prefer companies with millions of customers, tens of millions, hundreds of millions, billions even. Apple has over 1 billion iPhone users spread across every country on Earth. If 1 million people stop buying iPhones next year, it barely makes a dent in their financials. The revenue stream is diversified geographically, demographically, across countless individual purchasing decisions. If the Italian market slows down, maybe Brazil picks up. If older customers aren't upgrading, maybe younger customers are buying their first phone. There's balance, there's resilience, there's stability. But when you rely on one giant customer for the majority of your revenue, you're exposed to massive, unacceptable concentration risk. That's not a moat. That's a vulnerability. That's not a competitive strength. It's an existential threat. And vulnerabilities in business are opportunities for disaster, especially when they're paired with rich valuations. Think about what happens if Palantir loses even one major contract. Let's say $1 billion multi-year deal with the Department of Defense or Intelligence. That's not just $1 billion gone from the revenue line. That's $1 billion gone, yes, but it's also a signal to the market that something's wrong. Maybe Palantir's technology isn't as good as competitors. Maybe there were performance issues. Maybe the political winds shifted. Whatever the reason, the stock wouldn't drop 10 or 20%. It would drop 40, 50% in a day as investors panic and algorithms start selling. That's the risk of customer concentration at these valuation levels. The downside is asymmetric and catastrophic. There's also what I call the black box problem, and this one is particularly troubling for someone like me who values transparency above almost everything else. Palantir works on some of the most secretive projects in the world. CIA operations tracking terrorists and threats. FBI investigations into organized crime and espionage. Military intelligence gathering in war zones and hostile territories. Defense contracts related to national security. These are projects wrapped in layers and layers of classification. You can't read about them in the newspaper. The company can't discuss them in earnings calls. Analysts can't evaluate them. Shareholders can't verify them. It's all a black box. As a shareholder, you're supposed to trust that everything is going well inside this impenetrable black box. You're supposed to believe that the government is happy with the product, that it's working as advertised, that contracts will be renewed, that there are no hidden problems brewing beneath the surface. But you can't actually see inside the black box. You can't verify any of it. You can't kick the tires. You can't talk to customers. You can't read case studies. You can't measure the outcomes. It's faith-based investing, and I've never been a fan of faith when money's on the line. As an investor, I want transparency. I demand it. I want to read the annual reports and understand exactly what's happening inside the business down to the smallest detail. I want to know who the customers are by name, what products they're buying, what the margins are on each product line, how competitive dynamics are shifting, what the retention rates look like, what management is worried about, where they see opportunities and threats. With Palantir, you get none of that. You get vague statements about supporting critical missions and empowering decision makers and ontology-driven platforms. It's like being asked to buy a car without being allowed to look under the hood, sit in the driver's seat, or take it for a test drive. You're told it's a great car, best in class, revolutionary technology, but you just have to take the salesman's word for it. That's not investing in my book. That's hoping. And hope is not a strategy. Hope is what you do when you don't have facts. Here's another issue that concerns me deeply, something that cuts to the very core of Palantir's business model and scaling potential. Is Palantir actually a software company? Or are they really a consulting company dressed up in software company clothing to command a software company valuation? This distinction matters enormously. It's not semantics, It's the difference between a business that can scale infinitely with high margins and one that scales linearly with mediocre margins. True software as a service companies scale infinitely with almost no marginal cost. Microsoft can sell another copy of Office to a small business in India or a student in Brazil for effectively zero marginal cost. The software is already built, debugged, and deployed. The infrastructure is in place. The servers are running. You just give someone a license key, they download it or access it through the browser, and boom, Microsoft just made another sale with 95% gross margin. The beauty of software is that it doesn't cost more to produce the millionth copy than it did to produce the first copy. You build it once and sell it a billion times. That's what creates enormous wealth. Consulting companies are the opposite. They scale linearly at best, and scaling is actually painful and expensive. Accenture, Deloitte, McKinsey, these are consulting firms. They have to send highly paid human consultants to every single client. Those consultants can only work so many hours in a day. They can only handle so many clients at a time. They burn out. They leave for other opportunities. You're constantly recruiting, training, deploying, managing, and those human consultants are expensive. They demand high salaries, benefits, bonuses, career progression. Every new client you sign requires more headcount. Revenue and costs grow in lockstep. There's no magical margin expansion. You're trapped in a linear growth model. Palantir likes to present itself as a pure software company, but the reality is very different. They rely heavily on what they call forward deployed engineers, or FDEs. These are highly skilled people, often with security clearances, who go to client sites for months or even years at a time. They customize the software to fit the client's specific needs. They integrate it into existing systems and databases. They train users. They troubleshoot problems. They sit in meetings. They become embedded in the client's organization. That is consulting, not software. That's a services model, and it drags down margins significantly compared to pure SaaS businesses. Palantir will never be as profitable as Microsoft or as scalable as Google because every new client requires substantial human labor. The gross margins top out in the 50s or 60s instead of the 80s or 90s. The sales cycles are long and expensive. The customization work is unpredictable. Some clients need 2 FDEs, some need 20. You can't predict it with certainty. You can't standardize it. You're selling bespoke solutions that require expensive human expertise, not off-the-shelf software. That's fine as a business model. Consulting can be very profitable, but you shouldn't pay software company multiples for a consulting business dressed in software company clothes. The economics don't support the valuation. You're buying a labor-intensive business and paying as if it's a zero marginal cost software platform. That's a category error that will eventually get corrected painfully. Let me talk about insider selling now, because actions speak louder than words. And the actions I'm seeing from Palantir, insiders are screaming at the top of their lungs. Alex Karp, the CEO and one of the co-founders, has been selling millions upon millions of dollars worth of shares, not occasionally, not once in a while to diversify, but regularly, systematically, relentlessly, month after month, quarter after quarter. The insider selling reports show Karp dumping stock. And he's not alone. Other executives are selling too. Directors are selling. Early employees are selling. It's like rats fleeing a ship. Now, I understand that executives need to diversify their personal finances. I get it. If 90% of your net worth is tied up in one stock, even if you're the CEO and you love the company, It makes sense to sell some shares to buy a house, pay taxes, invest in other assets, fund your retirement. That's rational financial planning. But when the captain of the ship is putting on a life vest while telling everyone else that smooth sailing is ahead and the destination is paradise, you should at least ask yourself why. If Karp truly believed deep in his bones that Palantir stock was going to the moon, that it was dramatically undervalued and poised for explosive sustainable growth, that it would be worth 5 times or 10 times more in a few years, why would he be selling now? Wouldn't he want to hold on to every share and ride that wave? Wouldn't he be buying more if he could? Insider selling isn't illegal. It's not even uncommon. Executives sell stock all the time for perfectly legitimate reasons. But it's a data point. It's a signal. And when you combine it with all the other concerns I'm raising, the customer concentration, the dilution, the valuation, the complexity, it adds up to a picture of a company where the people closest to the operations, the people who see the books, who sit in the strategy meetings, who know the challenges and risks better than anyone, don't seem to have the same starry-eyed confidence that retail investors scrolling through Reddit have. Insiders are net sellers. They're cashing out. They're taking money off the table while the getting is good. And that should make you pause and think very carefully before you put more money in while they're taking money out. I've also noticed something about Palantir's management style and corporate culture that bothers me. Call it a philosophical difference, but I think it matters for long-term shareholder value. I like boring CEOs. I really do. I like leaders who are humble, who focus on operations, who talk candidly about failures and challenges, who admit when they were wrong, who make decisions based on data rather than ego. I like CEOs who are obsessed with capital allocation, who think constantly about how to deploy shareholder funds to generate the highest risk-adjusted returns, who would rather stay out of the spotlight and let results speak for themselves. Tim Cook is a good example. Quiet, methodical, focused on execution. Ajit Jain, who runs our insurance operations, is another brilliant, disciplined, zero interest in being a celebrity. Alex Karp is the complete opposite of this archetype. He's eccentric, flamboyant, philosophical in a very public way. He gives long interviews where he talks about saving Western civilization. He positions Palantir as a moral crusade, not just a business. He talks about fighting authoritarianism and protecting democracy and being on the right side of history. Now, those might be noble goals, and I'm not questioning his sincerity. But as a shareholder, I don't need a philosopher king running my company. I need a capital allocator. I need someone who spends all day thinking about how to generate returns for shareholders, not someone who's trying to be a public intellectual or a geopolitical commentator or a provocative media personality. When a CEO becomes a celebrity, when they're constantly on television or giving dramatic speeches at conferences or writing op-eds about the future of civilization, it's usually bad for shareholders. The focus shifts from the business fundamentals to the personal brand. The CEO starts to care more about their legacy and public image than about next quarter's margins. They make decisions to generate headlines rather than cash flows. Karp's promotional style is great for generating hype, for getting investors excited, for moving the stock price in the short term. But hype doesn't pay dividends. Cash flow pays dividends. Substance pays dividends. And I question whether the substance matches the hype when the CEO is spending time on book tours and media appearances rather than in the office grinding on operational improvements. Palantir is also what I call a story stock. And story stocks are some of the most dangerous investments you can make if you're not careful. The narrative surrounding Palantir is extraordinarily compelling. I'll give them that. They're involved in AI warfare, helping the military use artificial intelligence to make better tactical decisions. They're shaping the future of data analytics, integrating information from thousands of sources to create actionable intelligence. They're helping governments make better decisions, supposedly preventing terrorist attacks and cyber attacks and threats we'll never hear about because they were stopped before they happened. It's exciting. It's dramatic. It's patriotic even. It's the kind of story that gets your heart racing and makes you feel like you're part of something bigger than yourself. But here's the brutal, uncomfortable, money-losing problem with story stocks. Stories don't pay dividends. They don't generate cash flow. They don't compound wealth. The market will pay for a good story for a while, sometimes for years, bidding up the stock price to absurd levels based purely on narrative and excitement and hope. But eventually, inevitably, reality sets in. Eventually, investors want to see profits. They want sustainable margins. They want predictable revenue growth with clear drivers. They want return on invested capital that exceeds the cost of capital. They want proof that the story is translating into shareholder value, not just into PowerPoint presentations and marketing materials. I've seen this movie so many times it's like watching reruns. The market is a voting machine in the short run, responding to sentiment and hype and momentum. But it's a weighing machine in the long run, cold and clinical and mathematical. Right now, Palantir is being voted up enthusiastically because the story is so seductive and the FOMO is so strong. But when the market starts weighing the actual substance, the real economics, the cash generation, the competitive position, the stock could be in for a harsh, painful, wealth-destroying reality check. Don't fall in love with the story. Don't let narrative cloud your judgment. Look at the spreadsheet. Look at the cash flow statement. Look at the return on equity. The numbers tell the real story. And right now, the numbers are telling a very different story than the marketing department. Competition is another massive concern that I don't think gets enough attention. Right now, Palantir has a head start in the government and enterprise data analytics space. They were early. They built relationships. They got security clearances. They learned the procurement process. That matters, and it's created some temporary advantages. But let's be clear about what they're up against. Microsoft has Azure AI, Amazon has AWS, and a whole suite of AI and data tools. Google has been doing AI longer than almost anyone and has literally thousands of the world's top researchers. These companies, Microsoft, Amazon, Google, they have effectively infinite resources compared to Palantir. Microsoft alone has over $100 billion in cash and generates $50 billion in free cash flow annually. Amazon and Google are similar. They can outspend Palantir 10 to 1 or 50 to 1 if they decide data analytics is strategic. They already own the cloud infrastructure that every enterprise runs on. They have existing relationships with almost every Fortune 500 company and government agency in the world. An executive at Microsoft can walk into the Pentagon and say, hey, you already use Office, Windows, Azure, Teams, SharePoint. Why not add our AI analytics platform and we'll give you a great bundle discount? That's nearly impossible to compete against. Palantir is facing a war on 3 fronts simultaneously. They're fighting Microsoft, which dominates enterprise software. They're fighting Amazon, which dominates cloud infrastructure. They're fighting Google, which dominates AI research. Can a company with a few thousand employees and limited financial resources really fend off 3 of the largest, most sophisticated, most ruthless competitors in the history of capitalism? The odds are not good. I bet on the incumbent with a cash pile every single time. And in this case, Big tech is the incumbent. They control the platforms, the distribution, the customer relationships. Palantir is the upstart trying to defend a narrow moat against giants with siege engines and unlimited ammunition. It's only a matter of time before the walls crack. Let me explain something called the Rule of 72. It's a mathematical reality that every investor should understand. The Rule of 72 helps you calculate how long it takes for money to double at a given growth rate. You take 72 and divide it by the growth rate. If you're earning 8% annually, your money doubles in 9 years. Simple math. But here's where it gets interesting with Palantir. At their current valuation, growth isn't just priced in for the next few years. It's priced in for the next 20 years, maybe longer depending on which metric you use. That means the market is assuming that Palantir will execute perfectly for 2 entire decades. Every product launch will succeed beyond expectations. Every contract will be renewed at higher prices. Every expansion into new markets will work. Every hire will be brilliant. Every strategic decision will be correct. There will be no recessions deep enough to hurt them. No competitive threats serious enough to slow them. No regulatory hurdles high enough to trip them. No technological shifts fast enough to disrupt them. 20 years of perfection. Does that sound realistic to you? Because it doesn't to me. If growth slows even 1 or 2% below what the market is currently expecting, if execution falters even slightly, if one quarter disappoints Wall Street, the stock won't drop 10 or 20%. It could easily crash 50% or more because all that future growth is already baked into today's price. You're not paying for what Palantir is today. You're paying for what it might be in 2044 if everything goes right. And the math simply doesn't work when you lay it out like that. You need absolute perfection just to break even on your investment after adjusting for time value of money and opportunity cost. And I don't bet on perfection. I don't bet on best case scenarios. I bet on probability. And the probability here is that something goes wrong long before 20 years pass. The probability is that Palantir is a good company but a terrible investment at this price. Every investment decision involves opportunity cost. And this is something that most retail investors completely ignore in their excitement to chase the hot stock. Opportunity cost is the return you give up by choosing one investment over another. Money is finite, time is finite. You can't buy everything. Every dollar you put into Palantir is a dollar you're not putting into something else. So the question becomes, what else could you do with that money? What are the alternatives? And are those alternatives better or worse on a risk-adjusted basis? Right now, you could buy Chevron at 10 times earnings with a 4% dividend yield. It's a boring energy company, sure, but it generates massive cash flow, returns capital to shareholders consistently, and will still be producing oil when Palantir is long forgotten. Or you could buy Treasury bills and earn 5% completely risk-free. The U.S. government guarantees your principal and interest. You sleep well at night. No volatility, no company-specific risk, no execution risk, 5% annually for doing absolutely nothing. So ask yourself honestly, why would you choose Palantir trading at 80 times earnings over these alternatives? You're taking on massive execution risk, massive competition risk, massive valuation risk, customer concentration risk, all for what potential upside? The upside is already priced in. Meanwhile, you're giving up a safe 5% or a reliable 10% from value stocks with dividends. That doesn't make mathematical sense. Investing is about comparing alternatives and choosing the best risk-adjusted return. Palantir is the worst alternative on the board right now. The risk is extraordinarily high, approaching reckless, and the reward is already priced into the current stock price. You're not getting compensated for the risk you're taking. You're paying a premium to take on massive risk, which is the exact opposite of intelligent investing. My number one rule is dead simple, so simple a child could understand it. Don't lose money. My number two rule is don't forget rule number one. This philosophy has guided me for over 6 decades through bull markets and bear markets, booms and crashes, manias and panics, and it's rooted deeply in the concept of margin of safety, a term coined by Ben Graham, my mentor. Margin of safety means buying assets at a significant discount to their intrinsic value. That way, even if you're wrong about some of your assumptions, even if the business performs worse than expected, even if the economy hits a rough patch, you still don't lose money because you bought with a cushion. Palantir has no margin of safety whatsoever. None. Actually, it's worse than that. Palantir is trading at a premium on top of a premium on top of a premium. It's priced for perfection and then some. If they miss one earnings call by 5 cents, the stock could drop 20% overnight. If one major contract falls through, 30% gone in a day. If there's any disappointment, any setback, any hiccup in the growth story, the selling will be vicious and relentless because there's no fundamental support at these prices. You're walking a tightrope over the Grand Canyon without a safety net, without a harness, in a windstorm. That's not investing. That's acrobatics. And most acrobats, no matter how skilled, eventually fall. Don't be in the air when gravity reasserts itself. Inflation is another risk that people aren't discussing nearly enough, especially as it relates to Palantir's specific business model. Palantir's primary cost structure is people. Engineers, data scientists, forward-deployed engineers, salespeople, all highly skilled professionals who command top compensation in one of the most competitive labor markets in the world. And those salaries are going up significantly year over year. Tech salary inflation has been running at 10, 15, sometimes 20% annually in hot markets. The competition for AI talent specifically is absolutely insane. As wages rise relentlessly, Palantir's costs will increase faster than their ability to raise prices. Why? Because many of their contracts, especially government contracts, are multi-year agreements with pricing locked in. They can't just call up the Department of Defense and say, hey, our costs went up 15%, so we need you to pay 15% more. That's not how government procurement works. The prices are set. The budgets are approved. You're locked in. This creates a squeeze. Rising costs on one side, fixed revenues on the other, and margins getting compressed in the middle. A lot of people think tech companies are immune to inflation. They think software and data are somehow magically insulated from the forces that affect the rest of the economy. That's completely wrong. Labor-intensive tech businesses like Palantir, where humans are core to delivering the service, are absolutely vulnerable to wage inflation, and that will show up in the financials sooner or later. Gross margins will compress. Operating margins will come under pressure. The market will start questioning whether this is really a high-margin software business or a medium-margin consulting business. And when the market reclassifies you from software to consulting, your valuation multiple gets cut in half instantly. I have 3 boxes on my desk. One is labeled in for investment ideas that I'm actively considering and researching. One is labeled out for ideas I've rejected after analysis. And one is labeled too hard for ideas that are beyond my ability to analyze with the confidence I require before putting money at risk. That too hard box might be the most important of the 3 because it keeps me out of trouble. It prevents me from doing something stupid just because everyone else is doing it or because I feel pressure to have an opinion on every hot stock. Palantir goes straight into the too hard box without hesitation. It's too complex for me to understand with confidence. It's too expensive to justify rationally. It's too risky given all the factors I've laid out. Too much customer concentration, too much dilution, too much competition coming, too much opacity, too much hype, too much promotional management, too much, period. You don't get extra points in investing for jumping over a 7-foot bar when there's a 1-foot bar right next to it. I'd rather make easy, predictable, boring money on simple businesses with durable competitive advantages than try to be a hero and lose it all on a complicated bet that requires everything to go right. Palantir is a 7-foot bar, and you know what? There are hundreds, maybe thousands of 1-foot bars out there in the market. Boring businesses, unsexy industries, companies that won't make you sound smart at cocktail parties, but companies that generate cash, pay dividends, buy back stock, and compound wealth steadily over decades without drama. Why make it harder than it needs to be? Why take unnecessary risk? Investing is not about showing how smart you are or how much risk you can tolerate. It's about making money consistently over long periods while avoiding permanent losses. Simple beats, complex almost every time. Finally, let me talk about the greater fool theory, because this is really what's driving Palantir's stock price at this point. When you buy Palantir at current prices, be honest with yourself. You're not buying it because you think it's worth what you're paying. You're not sitting there with a discounted cash flow model saying, yes, based on my projections of free cash flows for the next decade, discounted back to present value at an appropriate rate, this stock is worth $80 per share. Nobody's doing that analysis and concluding it's a buy. What you're actually doing, whether you admit it or not, is buying it because you think someone else will pay even more later. You're betting on momentum continuing. You're betting on FOMO intensifying. You're betting on the hype machine, churning out more converts who will buy without thinking. That's not investing. That's speculation. That's the greater fool theory in action. And here's the brutal problem with this theory. Eventually, you run out of fools. Eventually, everyone who's going to buy has already bought. The music stops. There are no more buyers at higher prices. And whoever is holding the bag when the music stops loses catastrophically. Their shares might drop 50, 60, 70% before finding a bottom. I've seen this movie so many times it's like a recurring nightmare. It played out in the dot-com bubble at the turn of the century. Pets.com, Webvan, eToys, dozens of others. Great stories, compelling narratives, charismatic founders, revolutionary technology, but terrible businesses at absurd prices. It played out in the housing crisis. It played out in cannabis stocks. It plays out in every speculative mania that captures public imagination. The early speculators make huge money. They're the ones who bought at reasonable prices before the hype began. They sell into the frenzy and walk away rich. The late arrivals, the ones who buy because their coworker made money or they saw it on social media, they lose their shirts. They buy at the peak and ride it all the way down, paralyzed by hope and denial. The question you absolutely must ask yourself and answer honestly is, where are you in this cycle? Are you early, buying before the hype, getting in when the valuation was still reasonable? Or are you late, buying after it's already up 500%, after everyone's talking about it, after every YouTuber is pumping it? Because if you're late, and I suspect most retail investors buying now are late, you're the fool that earlier investors have been waiting for. You're the exit liquidity. You're the bag holder. Now let me bring this all home with a conclusion that might not be what you want to hear, but it's what I believe after decades of studying businesses and markets. Trees don't grow to the sky. That's not pessimism. That's not being a hater. It's physics. It's mathematics. It's the inevitable force of gravity and competition and economics. Every company, no matter how great, has limits. Growth rates slow, markets saturate, competitors emerge, regulations tighten, technologies get disrupted. It happens to every single company eventually. There are no exceptions. Valuations matter. They always have, they always will. You can ignore them for a while when sentiment is strong and money is flowing and everyone's making money. But eventually, and always sooner than the optimists expect, fundamentals reassert themselves. Stocks trade based on their cash flows, their earnings power, their competitive position. A stock trading at 50 or 100 times sales will eventually revert to something more normal, whether that's 5 times sales or 10 times sales. That reversion can happen through price declining, through sales growing into the valuation over many years, or some combination. Usually it's price declining because sales can't grow fast enough to justify those multiples. Palantir might very well change the world. I'm not saying the company is worthless or doomed. They might revolutionize how governments operate, how companies make decisions, how we fight wars and prevent terrorism. They might become essential infrastructure for the digital age. I'm prepared to acknowledge all that is possible, maybe even likely. But here's the massive, critical, account-destroying distinction that gets lost in all the hype. There's a huge difference between a good company and a good investment. A good company at a bad price is a bad investment. Let me repeat that because it's crucial. A good company at a bad price is a bad investment. And right now, Palantir is a potentially good company at a terrible, awful, wealth-destroying price. It might bankrupt your portfolio even if the company succeeds wildly, simply because you overpaid by such an enormous margin. If you pay 100 times sales and the company only grows to justify 50 times sales over the next decade, you lose half your money even though the business did well. Your returns are determined by the price you pay, not by the quality of the business alone. Pay too much and you lose even when the company wins. Stay safe out there. Stay rational. Don't let hype cloud your judgment or FOMO drive your decisions. Don't invest based on what your brother-in-law is doing or what some YouTuber told you or what's trending on social media. The greatest investors in history made their fortunes by being patient, disciplined, and unemotional. They didn't chase hot stocks. They didn't buy what everyone else was buying. They found value where others saw nothing, and they avoided danger even when it was wrapped in an exciting, seductive package. Palantir is danger wrapped in hype, tied with a bow of compelling narrative. See it for what it is. Acknowledge the risks I've laid out here, and most importantly, protect your capital, because once you lose it, getting it back is incredibly difficult. Losing 50% requires 100% gain just to break even. Don't put yourself in that hole.